So it was a marrying of technology and finance because it was algorithmic trading. That's why, you have concept like EPF and all that. People
Correct.
are forced to save in EPF, forced to save in some LIC policy. Investing 10,000 rupees a month when you're 22 and investing 1 lakh rupees when you're 35 is roughly the same. They asked me if they can do Bitcoin. And I said, look, you want to do it, you guys go up and do it, but I won't do it. Don't do anything that does not allow you to sleep at night.
हेलो, हाय, नमस्कार, आदाब, अभिनंदन और आभार. Ladies and gentlemen, boys and girls, देवी और सज्जनों, this is your host and दोस्त कनिष्क गुप्ता and welcome to our channel Wealthy Talks. और इस चैनल के थ्रू हम लेके आए हैं आपके लिए एक बहुत ही इंटरेस्टिंग सीरीज जिसका नाम है #Meriinvestmentstory. कुछ ऐसी इंस्पायरिंग जर्नीज जहां हमारे गेस्ट आपको बताने वाले हैं अपनी इन्वेस्टमेंट स्टोरी कि वो कहां से शुरू हुई, कैसे स्टार्ट हुई और आज कहां खड़ी है. एंड होपफुली वी बिलीव कि उनकी ये स्टोरी सुनने के बाद आपको कुछ सीखने मिलेगा, कुछ लर्निंग्स मिलेंगी जो आप अपनी इन्वेस्टमेंट स्टोरीज में अप्लाई कर सकेंगे. एंड विच इज वाई वी आर किकिंग ऑफ आवर वेरी फर्स्ट एपिसोड विद अ वेल नोन नेम इन द इंडस्ट्री. एक ऐसी पर्सनालिटी जिन्होंने फाइनेंशियल वर्ल्ड में काफी कंट्रीब्यूट किया है. ही इज नन अदर देन द फाउंडर एंड CEO ऑफ कैपिटलमाइंड, मिस्टर दीपक शेनॉय. सो थैंक यू सो मच दीपक सर फॉर गिविंग योर वैल्यूएबल टाइम टू अस. एंड तो मेरे पास आपके लिए बहुत सारे क्वेश्चंस हैं, पर फिर भी मैंने बहुत कोशिश करके अपने लिए 4-5 क्वेश्चंस रखे हैं. सो माय वेरी फर्स्ट क्वेश्चन इज लाइक यू कम फ्रॉम एन इंजीनियरिंग बैकग्राउंड. आप एक कंप्यूटर साइंस इंजीनियर है. यू आर फ्रॉम NIT सूरतकल and now you are a founder and CEO of Capitalmind. So being from a software engineering journey to a finance enthusiast, like what made you jump into this particular field?
Well, firstly, Kanishk, congratulations and all the best for your podcast and
Thank you, sir.
videocast. But my journey comes from, I think, I started off as a software engineer. So my concept of finance has started as a journey only after my engineering. So before that, I was not very exposed to markets or finance or investments or credit or anything like that. So most of us learn anyway, it's on the ground kind of learning. But my job, I started my first company in 1998. So that's when we were building something in finance, an accounting software for people in India.
Okay.
So for companies in India. And in the process, well, my partners knew a lot about accounting. I didn't know anything about accounting. So I had to learn some of this just to figure out what is accounting, what is software, what is software for accounting, what do you do for that and all that. But also a lot of business fundamentals. So we were running a company, so we had to manage our own finances. But we also had to understand other companies' finances in order to be able to understand how everything is accounted for and how things are done. Through this process, conceptually, we understood finance. Practically, I understood finance because how companies actually do things.
Correct.
And in the end, you found out that there is a large field in the investment area, which is very interesting. Over the time, I think it was 2005 before I got enough experience and confidence to start writing about finance. So I started writing, and when you write, you learn about finance. So wo to part chalta hi raha, and then I started off with investing, and then went to futures and options. I did intraday trading and long-term trading, momentum, technicals, fundamentals, the whole thing over different time frames. So in 2007, actually, I started another company that was primarily eventually became a sort of a hedge fund, which was investing in markets in the sense of it was only our money. It was not something that we actually eventually did not raise from any other customers, but we set up a lot of database frameworks using technology. So it was a marrying of technology and finance because it was algorithmic trading.
That was an interesting line, marrying of technology and finance. Yeah.
So, I mean, the concept of algorithmic trading was new to India at the time, and it was very well established rest of the world. So I had moved to Bombay. I had with my family, I had set up a small kind of home office over there, and we had worked with a broker. 2008 was really tough because the market was violent. It was much more violent than anything we've seen in the last few years. It was also a very difficult environment for people who were trying to do anything like electronic trading and all that stuff, because the APIs, the technology was just not there. So we were I learned more about finance using that at that time, because a lot of stuff was being built from scratch. Today you have a lot more, companies providing APIs, and a lot of the infrastructure is much better settled than it was at that time. So, but then that experience set it up, and I worked for another hedge fund which was also into algo trading.
Okay.
And then I said, okay, we have to do something more for retail people. So we were looking at building retail. I was in Gurgaon. I moved to Bangalore. I set up Capitalmind here as a business. By that time, there was a lot of people that were looking to buy or even subscribe to content, which was good financial content. That part of it kind of built it and said, we'll build content, we'll build portfolios, we'll build a community. And that's what Capitalmind started off being. And eventually we set up the PMS, where our customers themselves told us that I want to manage money. The transition was very slow. In fact, I got my MBA only earlier this year.
Okay.
Largely because SEBI said कि आपको MBA लेना ही पड़ेगा type thing, which is at least my venture into the MBA world, and I did it through the pandemic. Okay. So it was relatively easy because I was studying from home. But what was interesting was we built the PMS starting 2017. Now we're about 1,100, close to 1,100 crores in management. We largely built it with a very simple concept. Keep your fees and structure simple. Keep your strategies simple. Don't overcomplicate things. Keep it honest and transparent, so our customers can see everything that we do. We don't hide anything from them. We don't tell them कि आपको नहीं बताएंगे आपके positions क्या है. We don't tell them anything that is out of the ordinary. Therefore, I think sometimes simple just makes a lot of sense because it's just easy to work with. That is what kind of drove, and that also comes from a tech philosophy. In tech also, you kind of, if you can always overcomplicate everything, and then the simplest thing works in tech. So if you marry that to investing, it's pretty much like don't overcomplicate. Like, look at all this crypto nonsense that happens. It's all about overcomplicating stuff, and that kind of things just go and become opaque, and fraud and all of that stuff happens. And I think in securities markets of all sorts, whether it is crypto or anything like that, the less transparent you are, the more chances are that people are losing money because of misinformation or fraud or anything like that. So we said, okay, let's keep it simple, honest, transparent. So I think, the elements of tech come into everything we do. We still own all of our technology. We didn't buy a lot of the off-the-shelf kind of solutions. We built all of our PMS infrastructure in-house. And that has served us well because we're able to expand without having to add more people. So relatively, we are small. There are 26 people that are running the company, that are in the company. Correct. And lean team, simple machine that's been going around.
Great, sir. That was really amazing. Sir, so now my second question to you is, how did you start your investment journey? Like, for me, मेरे dad ने जब तक बोला नहीं, पकड़ के करवाया नहीं, मैंने किया नहीं. So how did you start your investment journey? Like what was your first investment? And then did you do it on your own, or you took advice from friends or family? And how is it going now? Like you would be having your, you must be having a great portfolio. So what was your first investment and how does it looks like now?
So I think, my family has been a family of bankers, so they've always invested in shares from a long time. So I was exposed to the fact that there is a share market, but I didn't really understand what it was. So it was at that time there was no online anything. So most of these 80s and early 90s, it was mostly paper. There would be one column that would come that gives a share price once a day. So essentially once in a week, my father used to make me read out the prices. Whatever shares he had, I had to find them, read out the price, and it was really small print, so he couldn't read it. So he would say, you read it for me, and I would find the stocks and read it. But that's all. I just knew that. I didn't even pay much attention to a lot of the stuff that was happening. But I wish he was there, but he passed away in 97, and I didn't really understand the concept of investing until much after he passed away. I kind of learned it almost from scratch, and when in 2000, I think when there was a big dot-com boom going on, that's when we said, okay, kuch to karna chahiye, we should buy at least a mutual fund. That time there was a tech mutual fund. We bought it. It went down 80%. So we learned very quickly that, ye greed mein buying and all is not a good thing. And then in 2002, again, the markets were low. So I started to look at investing. There were some online brokerages that I just started. So I was happier doing that. And if you're in the old school, you would call up your broker and say, "Aap kharido." I didn't like that concept. I said, I want to buy, I want to see what I'm buying and all that. So it was very clunky at that time, the interface.
Okay.
But I somehow managed, so I had very little money. So the first set of investments, actually the first investment was a disaster. And then the second set of investments that I did, which was directly into stocks, those did much, much better.
Okay.
Also because I was investing in a market that was starting to come back up. It was 2002, 2003. And that was the time when stocks were starting to look back up again. They had been down 60, 70% in 2 years. So whatever you bought, no matter what you bought, it would start to rise in a short period of time. So saw that there was a lot of stuff that you learned while you do this. You saw stocks. Then in 2004, futures and options started to become popular.
Okay.
So I learned much about them and figured out how we can do that also. I did a little bit of that through the process. In fact, I wrote a lot of it on Capitalmind through the process. Kya kar raha hu? What am I doing? How do I? So I moved from a fundamental long-term investing framework to something more shorter-term trading framework because I wanted to understand how the markets work, and I did a lot of stuff around that. What's interesting, of course, is that now it's very easy because you go online, you find all these courses on this. At that time, all the courses and material that you would find were all abroad.
Okay.
And they didn't really, many times those concepts didn't apply because in India, you don't get the same data. You don't get the same quality of data. Conference call transcripts are not easily available. Conference call koi karta bhi nahi tha. There would be a problem. So through the process, even India evolved to the point where now I think in 2022, I can confidently say conference calls are available, transcripts are available, data is available. A lot of it is available for free. The APIs are available for directly trading with brokers. So we've actually migrated to where maybe the US was in 2004, 2005 to where India is now. Of course, India is a lot more safe as an ecosystem compared to the US and well regulated. But now, of course, almost all my money is in the PMS.
Okay.
I just put the money into the PMS, which we manage. So we run the portfolios there. And it's done really well. I'm very happy for that decision myself for two reasons. Of course, it proves that I have confidence in my own PMS. We manage other people's money. We should be managing our own money also in the same way.
Correct.
The second thing is, of course, the returns have been really good over the last few years. My average expectation of markets has only been 11 to 12%. That is I don't expect more from markets in general. So the last maybe 3 or 4 years since I've started to invest, because roughly 5 years is the investment time frame that I've had, just the amount of money that I've kind of put in the PMS itself has given a significantly higher return. So we're talking, even if I look at all of our strategies put together, and including the debt that I own, though I had a small debt portfolio, my returns are upwards of 14 or 15% per year, which is not too bad. So, and this is about consistent investing all the time and so on. So now I don't bother too much about either buying a mutual fund. I don't need to buy a mutual fund because we invest in stocks directly, but I do buy debt mutual funds. Okay. So for debt, I do use mutual funds, and for equity, largely, you have placeholder positions saying, "Acha, I want to see how this mutual fund does." So you put a small amount there just to see how it does. It's not really for that, but my majority of my large investments come into the PMS. It gives me more confidence also because A, I'm managing it, and B, over time, I've figured that, something like this, an investment strategy that consistently kind of invests in the same fund or same thing, if you're confident enough about it, will actually give you great long-term returns. Okay. So even if you see something as bad as 2020, markets fell 35%. Correct. You're not too bothered because, there's a lot more that will come, and the markets have recovered fairly well, so it's okay. It's fine. It's a good thing now. I'm happier this way.
Great. So sir, what has been your biggest motivation of, I want to invest money, I'll keep investing money. So what has been your biggest motivation there?
I think it's very simple. If you look at markets or any kind of this thing, they're the best ways to make money after you've made a certain amount of money. So the first few years of your life, you'll only focus on making money.
True.
Because salary increases itself will give you enough bump. So for younger people, they invest something like 1,000 rupee SIPs. I think that's a waste of time for even for me. It would have been how much ever money I invested in that tech fund and what I lost is nothing today. I mean, I look at that and I laugh. Ki kya tha, you know what? So I think at that time to have struggled to put all this money into a fund and all that was a waste of time. I could have just, if I just worked a little bit harder, I would have doubled or tripled my salaries. And I was running a company, so I could see more money coming if we just did some small improvements in the business. So I think early on it's only about focus on making money.
Correct.
Eventually, as you grow past your 35, 40 kind of age group, that is when you'll kind of have enough money that is allowed if that is invested, that will give you a much larger return. So today, if I looked at overall how much ever I earn versus how much ever I make from the investments, the investment part is a significant number. So the effective monthly return, if you average it over a couple of years, you're actually making a significant amount compared to even what you earn. At one point, I hope to make it reach a point where it is way more than the amount I make on the salaries. So where so much more that my salaries won't matter anymore. So the idea is that the motivation was to build an asset, and I think my biggest asset is of course Capitalmind because I'm a founder here.
Yeah.
But my second biggest asset is the liquid money that I have, which sits in stocks for the most part. 80% is sitting in stocks, and about 20% is sitting in debt funds.
Okay.
Some cash is as cash comes by, I deploy it, and always in a slow mechanism. I don't just jump in and deploy everything. So.
Great, sir. So, sir, my next question to you is, we see a lot of videos today, people talking about how you should invest in your 20s, why you should invest in your 20s, what benefits you are going to have if you start investing at your 20s. But then there are a set of people, we believe who have not done investments even when they are in their 30s or in their 35s. So if you have to say something to them, or if you had to give them suggestions that if you have not invested till now and you have you have gone beyond 30s and your 35s, what would you say to them?
So I think 30-35 is fine because that's young. I'm 47, so it doesn't matter to me.
Dil young hona chahiye.
No, but really, I think the concept is, until you're 35, 40, you're mostly paying for your house.
Okay.
You're probably bought a house, you're doing some EMI. Wahi hoga. There won't be nothing left to invest. Very little. Nowadays, of course, kids have a lot more money because you end up with a starting job itself that gives you so much money that gives you enough to save. So you should save because you're not spending.
Correct.
But don't stop your spending for saving. If you're having fun, have fun. That's what life's about. No, have fun. There'll always be money that will come later. And as you grow in your careers and your lives, you'll eventually have a lot higher disposable income. So now you can always start. I've seen people start in their 40s and build a sizable corpus by the time they're 50 also, even within a few years, because all it takes is a little bit of effort. And once you get to that point, now if you're past 50, 52, 53, and then you start to invest, then you have trouble, because that's why you have concepts like EPF and all that. People are forced to save in EPF, forced to save in some LIC policy or something like that. That helps people like that, where they don't invest at all. They forget to invest. And suddenly at 50, they realize that, I'm going to retire. What do I do now? So then at least they have some forced saving. But I would typically say, if you're not spending some money, invest it. Don't just keep it in a bank account or go buy a second house. It's a waste of time. Buy your first house because you want to buy a house and all that stuff. But and again, don't overpay for it unless you can afford it. But in general, I would say once you get past that, go into liquid instruments, and that the liquid instruments can be combination of debt and equity and gold. I don't like gold, so I tell people don't buy gold at all. But in general, I would say if you have a surplus, invest. It doesn't matter when you start. Only if you're in your 50s, you may be a little bit in trouble, and you'll have to figure out, maybe if I was planning to retire at 58, I have to retire at 65 because I need to work some extra years to generate more income. But otherwise, you'll be fine. And it's okay. It's there's nothing wrong with it, because investing 10,000 rupees a month when you're 22, because you have only 10,000 rupees.
Correct.
You're spending the rest. and investing 1 lakh rupees in your 35 is roughly the same, because you'll have that 1 lakh rupees in your 35. The guy who's investing in 22 may have a bigger starting point, but you'll find that that person who starts at 35 with a larger amount will quickly catch up.
Okay.
Because they are investing more. And what happens typically is you're investing 10,000, you keep investing only that 10,000. Your mind blocks. It doesn't increase the amounts that you invested. And you should be. Because 10,000 kiya, so next year you should do 11,000, 12,000, 15,000. Keep increasing it to the point where by the time you're 35, it should have reached 1 lakh already. But you won't, because mentally you keep saying, I have been doing it for 10 years, it's okay. But if you don't increase the amount that you invest, you'll find that you'll end up short somewhere, because your income is increasing, but your savings are not increasing effectively. You're saving the money, but I don't know what, you're spending it somewhere. So you should increase the amount of investments also corresponding to the earning that you're having. So saving late and starting late is not a problem.
Okay.
Saving early is good, but you have to remember to increase the amount of investment over your period of your career.
Great, sir. Any tips that you would like to share for the viewers that who have not who are scared of investing, who thinks कि यार investments नहीं करनी, थोड़ा डर लगता है कि पता नहीं market में कब ऊपर हो जाए कब नीचे हो जाए. So if there are some tips that you would like to give to the viewers कि you should not be scared of investments, rather you should learn, and how they can learn more basically.
Cool. So here's here's the core thing that I would say. Okay. The tips that I would say is, I wrote this in my book as well. You start with hygiene. The hygiene factor is simple: emergency fund and insurance. So you get yourself health insurance, because if something happens to you, you need to be paid. You need to pay at a hospital. At least the health insurance will come in handy. If you have dependents, people at 22, 23 don't have dependents, so they shouldn't be buying it. But once you have children, or if you're the only earning member in your family, then your family has to be taken care of in case something happens to you. So you should buy insurance, life insurance. So that's the second part. And then an emergency fund that says, well, if I don't like my boss and I want to leave the company and I don't have any income, how do I survive? You create an emergency fund for 6 months of expenses. Okay. So you keep this in handy in case you want to take a sabbatical. I want to backpack across Europe, I want to do something. So this idea of an emergency fund is essentially to ensure that you are safe in case something happens to you. So before you start investing, fill these buckets. Okay. These are buckets that you must fill. Beyond that, you can invest and all that. Investing for the first time is always scary. So start small, I would say. But invest, because I was talking to some 9th standard children yesterday, and they were also asking me, should we invest now? I said, first, you don't have any money for the most part, but whatever money you do have, you can invest in phases, in parts, instead of doing all of it at the same time. And consider that a fixed deposit for you is also an investment. So you can start there, and then you can scale it up from there and build something on the investment front, like equity. So now I tell my children also, I'll, instead of your pocket money, I'll invest in equities or in debt, whichever you guys want. So, they were scared when the COVID thing happened. No, market fell. No, let's go to debt. And they saw it come back, and then they said, oh, no, we should do equity. They asked me if they can do Bitcoin. And I said, look, you want to do it, you guys go up and do it, but I won't do it. But they're aware. So people are aware that there are investment choices that are available, and I think you should experiment with them at a small level and then slowly build your confidence to build it up. You can start off buying, let's say, mutual funds or index funds or something like that, which aren't as volatile as buying individual stocks. Correct. And eventually graduate to a point if you are interested. So there are 3 things that you need. You need the knowledge of or what I call the skill. You need the inclination, which means you want to invest and you want to learn more about investments. And then third, you have the time, because some of these things can take inordinate amounts of time, looking through balance sheets or understanding charts or going through commentary. And I would say, going to an advisor is like, once you know that you do not have one of these 3. If I don't have the skill, I don't have the time, I don't have the inclination, one of the 3, then you can go to an advisor, or you can go to a mutual fund, or you can go. So the idea being, you transfer the responsibility of selecting what to invest in to somebody else. So a mutual fund is basically saying, I don't know which stocks to buy, please buy for me. I will give you my money, and it's well regulated, where it goes. Advisor may actually tell you, listen, I can't buy on your behalf, but I'll tell you what to buy, you buy it. So an advisor may tell you, that kind of advice. So it's still a little more hands-on kind of an approach. And then you have PMSs where which is a minimum of 50 lakhs. So you're actually going to have to trust the manager to say, well, I can manage it even better than say a mutual fund, or I can give you an exposure that a mutual fund cannot give me, or I have a strategy that kind of works better than a mutual fund. That's when you might say, okay, 50 lakhs will go to a PMS, or you have other ways to invest. So you want to graduate up this curve, and therefore start with the very basics, which is either index funds or mutual funds, active mutual funds. Problem is, of course, there are some 4,000 mutual funds. How do you select them?
Correct.
And then that's another process. You need a half a PhD just to select mutual funds. But in general, I would say, don't do the standard thing of ranking funds by some 1 year return, and because returns matter over a longer period of time. Everything that works in the last 1 year I want to make sure it also works in a 3-year period. It also works consistently over any 3-year period that you've selected. So you want to see something called 3-year rolling returns or 5-year rolling returns, just to see whether the funds have been consistently performing, and how much volatility. So if they fall 50% and then come back up 60%, is that good for you? Or are you okay with something that only falls 10%, 15% comes back? So there are different kinds of funds. You'll have to spend some time looking at this and understanding it. But once you do it, it should be a fairly smooth process. Most importantly, I think, don't do anything that does not allow you to sleep at night. Don't borrow money to invest.
Correct.
Don't have credit card debt. Credit card debt is the worst kind. So even if you have to take a personal loan to pay off credit card debt, do it. Don't buy stuff you don't understand, because there's a lot of stuff so you don't understand crypto, but everybody's telling you to buy crypto. Don't buy it, because it's not a useful thing to do. Don't generally just go and buy an insurance policy because somebody has given you some spreadsheet that sounds good. Do a little bit of a Google search, understand if other people have analyzed the policy, and if that policy or if that concept is worth it. Most ULIPs or insurance policies are which return money to you when you're alive. So a term insurance is which only returns money when you're dead, if you're dead, and it gives it to the next of your kin. But anything that gives you money back when you're alive is probably not a good thing. So it's not insurance in a way. It's a saving policy that they disguise. I would say avoid it. But if to know whether to avoid it or not, you have to make sure that you understand the policy. If you don't understand it, don't buy it. So these are small hacks in general. And then, as you grow confident in the investing, I think you'll find your own rules.
Great. So thank you so much, sir. It was lovely talking to you. Like, honestly, मुझे बहुत कुछ सीखने मिला, and I'm very much sure that the viewers are also going to learn a lot from this particular episode. And once again, thank you so much, sir. And तो ये तो थी #Deepak sir की investment story.
Thank you so much, Kanishk, and all the best to all of you.
तो गाइज, ये तो थी मेरी इन्वेस्टमेंट स्टोरी बाय दीपक सर. अगर आपको ये वीडियो पसंद आया तो वीडियो को शेयर करें और लाइक जरूर करें. और हाँ, अपनी इन्वेस्टमेंट स्टोरीज हमें बताएं बाय पुटिंग मेरी इन्वेस्टमेंट स्टोरी एंड टैगिंग वेल्दी along with your 3 friends. Some of the best investment stories will stand a chance to feature on the Wealthy page along with some gift hampers. तो सोचो मत, जाओ और शेयर करो. Think wealth, get wealthy.